My name is Nicole Schaefer. I am the Director of Her Traditions at York Traditions Bank. And I want to take a moment and just give some deep appreciation for each of you joining us for today's session. I know how busy our lives are, but investing in your financial health is hands down one of the best ways that you can invest your energy to have the biggest impact on your life. So making time can be a challenge. As a mom, as a caregiver for my grandmother, as someone who is very invested in my work and our community, I know how hard it is. And so during today's event, please eat your lunch if you're having lunch. Don't feel shy. We know how hard it is to make it all happen within a day. Also, we did save some time at the end for Q&A. However, if you have questions throughout the event, drop it in the chat or just save your questions for the end and ask them yourself. Today, we are lucky to have two very smart women with us to share their thoughts on investing. To get us started is Lola Lamatos. Lola is the private banking manager here at Traditions Bank, and she is going to kick us off with talking about why investing is so important, especially for women. Lola?
Good afternoon, everyone. We thank you for the opportunity. Women control 51.3% of the investable wealth of the United States, and it's predicted to reach 66% by 2030. We have more single female-run households, women actually working and men staying home to watch the children, and we have more and more women taking care of their parents and their investable income. You can ask any woman, are you confident about your finances? And most will say one of two things. I think we have some reaction buttons back down there. I wanted to get some reactions from some of you. How many of you would say you are confident about investing? If you're confident, put up a thumbs up. If you're not too confident, let's do the face with the circle. It should be next to the one that's laughing, or the laughing one because you need some help. So interested to see kind of where everyone stands with investing. I see some. I gotta move my. Oh, there we go. I got somebody with the hands up, and predominantly I see lots of wondering faces. Most women would say they need to learn more and they should be doing more. And also shows that we as women, we don't have very much confidence in our investment abilities. And that's why Her Traditions, we wanted to focus today on doing some of the basics of investing and things to consider as women on why we should change the way we are doing things and thinking about things. Women, we make investment decisions every day, first and foremost with our time. I know I have an Outlook calendar that's color-coded, family, work, friends. I'm busy running my kids around, balancing my time. Whether you're out there doing the same thing or whether you're running a household or a business and then we need to make a purchase, not one of you probably goes out and just buys something. Women tend to do extensive research, consumer report ratings, cost analysis, etc. We feel we have the skills in order to save. 62% of us feel that way. All our lives, we inherently save. We save for vacations, we save for holidays, we save for kids' colleges, things we want to buy. Statistically, we save an average of 9% of our annual pay outside of any retirement plan. So we do a great job of saving, but we need to change our attitude a little bit and we need to focus on growing our wealth. And growing our wealth is not just saving money, it's investing money in a manner that can outpace inflation and yield a higher return. Women, we do a great way of retiring. We participate in our retirement plans, but not always up to the percentage levels where company is matching and not increasing over time. We must start investing earlier and more aggressive. Women, we tend to be more conservative because we are used to saving with a purpose and not necessarily for retirement, not long-term. And sometimes that takes a back seat to everything else that we do in our lives. An average female investor keeps 68% of her portfolio in cash or cash equivalent, like treasury bills, money market accounts, CDs. Only 21% of us are actually willing to invest in stocks. That's because we just don't have the confidence. For example, if we start investing at the age of 25, $500 each month, and that's outside of whether you're doing it in your IRA and your company is matching, just as an example. So we're doing $500 each month until we're 65. That's $240,000 that we've saved up. We tend to be a little bit more conservative. So if we're doing it at earning about 3.5% and a mix of the things, we would have about $500,000 at the age of 65. If we would just be a little bit more aggressive and invest some in stocks at 7% over the 40 years to 65, we would have roughly $1.2 million. Most would say women are not risk takers. I think that women are risk aware and not risk averse. We sometimes need to make a decision longer time. We need to do a little bit more research. We need to be guided in the right manner, but we will be motivated to take risk if the decision is aligned with our values and our goals. Oftentimes, we are ill-advised by traditional advisors or friends to stay in short-term bonds and cash to avoid risk. But we need to listen and be working with someone who is not assuming what we want because we're a woman. They should do a complete profile of who you are, discuss your goals, your expectations, discuss products, services, and risk. And we will be getting into those items when Emily takes her role. A community banker and your financial planner can help you match your investment personality, your investment goals, with the appropriate assets to help you reach your goal. Identifying your financial investment personality can help you become more competent and a confident investor. On our website, traditions.bank, you're able to take a personality questionnaire, a financial personality questionnaire. We then take the time to review that with you, and it gives you a little bit of insight on how you do things. Emily and I and Nicole were discussing just the other day someone who took our personality questionnaire, and they were risk averse to having debt. So this person focused 5 years on paying off a car loan that was at 0% at the expense of contributing money to their IRA and their 401k. We had to understand that they were risk adverse and meet the challenge on where we can find a median road in order for that person to start investing in their 401k and put behind a little bit of that debt. Understanding your partner's style is also very important, and incorporating in that what you do every day in your budget and how you're investing your money with your spouse or significant other. We find that after a spouse's death or a significant other, women switch advisors over 75% of the times because they felt they were never involved or given a say or even understood. Women tend to feel more strongly about their values and the social and political and environmental impact of brands they purchase and organizations they support. And you can also do the same thing with your investment decisions. Statistically, we are better investors. We stick to things longer, we do our research, and we tend to earn a little more in our investments when we give them the opportunity. Remember, 62% of women feel they have financial skills to save for retirement. However, only 43% of women feel they've planned adequately for retirement. And we are right. Why should we be so concerned about retirement? Women are 80% more likely to face poverty in retirement. The average life expectancy for a woman is 81.2 years. We live longer, so we need more money, more long-term savings. We need to take into consideration those lifestyle expectations, the cost of healthcare, and long-term care, the increased cost of living through the years and the impact of taxes. Women's role also as a caretaker is at the expense of career earning potential and personal financial security. I took 10 years off of my career to start my family and get to a certain point where I felt comfortable to return to work. However, I don't look back and regret staying home for 10 years, but I do look back and regret that in those 10 years, I did not make a single contribution to my IRA account or a Roth IRA or anything. So that's 10 lost years of potential. So my advice out there would be continue to make IRA contributions or Roth, regardless of what stage of life that you're in. If you're self-employed, if you're a stay-at-home mom, even if you are working, make those contributions. Also, make sure not to forget about any retirement plans you have at prior employers. You can look to consolidate those at a trusted advisor or get a free consultation. In 2020, unfortunately, a woman made about 80 cents to every dollar a man earned. Unfortunately, with gender gap pay, women tend to have a smaller savings. We need to advocate for each other, fight for better and equal pay. There are tools that make it easy to compare salary, date base on your job title, experience, and geography, all online. So when you are going in to ask for a raise, that you have a little bit more confidence. And that is also something that your community banker, your financial advisor can help you with. What increase would benefit you? Where could you invest your money wiser? How increases impact an increased 401k participation? Budget your yearly increases. If you live without that money last year, you can do the same. So try to increase your 401k contribution every year. Most retirement websites have calculators to see the impact of the increase to your pay. And don't forget your self-employed SEP and IRA, Roth every year. Traditions Bank has partnered with RBC for very many years. And I've been fortunate to have been a client of theirs even before joining York Traditions, now Traditions Bank. I became a client about a year before I started to work here. And it was the first time that I was able to sit down after 20 years of working and actually review where my investments were, what they were doing, and realign them to what I wanted and contribute to things that made sense to myself. So we welcome the opportunity to sit down with any one of you, and we'll talk a little bit more about that at the end of the session. I'm really excited to have RBC here today and really excited that it's Emily Sides, because only 23% of certified financial planners are women. So it's exciting to be here and represented and listening to a woman giving other women advice. So I'm going to turn it over to Emily.
Thank you so much, Lola and Nicole and everyone at Traditions Bank for having me here today. I am so excited to be here and to talk with other women about some basics of investing. I am going to share my screen here and pull up a presentation as I go through some slides, so bear with me. All right. So can someone give me a thumbs up if they can see my screen? Awesome. Perfect. So I'm going to get started right away. I have a lot of information to cover today. I think as it was already mentioned, we are going to do a Q&A at the end. So feel free to jot down any questions you might have about any of the information that I go over. On this first slide, I just thought I would introduce myself a little bit and my team. As you all know by now, I'm Emily Sides with RBC Wealth Management, and I am a part of the Sides Group team. I am one of 5 advisors on our team, and I'm the only female advisor. We also have 3 support staff as well that help manage our business on a day-to-day basis. We do have a team website, and we also have a presence on LinkedIn and Facebook. If at any time you ever want to check us out, please feel free to do so. The links are also on the screen here. So some of the topics that I'm going to be covering today under the hood of basics of investing, I'm going to talk about some common investment types. So think of things like stocks, bonds, mutual funds, ETFs, all names that I'm sure you've heard of and you're familiar with, but you might not know what purpose they serve in a portfolio. I'm also going to talk about some different types of accounts, so retirement accounts, savings accounts, things like that. I'm going to talk about the difference between saving pre-tax money and Roth money, specifically related to saving those in retirement accounts. I'm also going to talk about the power of compounding and the rule of 72. I am going to bring in a mathematical formula there, so bear with me when we get to that point if math was not your favorite subject. I'm going to talk a little bit about the effect of time and possibly timing the markets and what that looks like. Some current events that have been going on over the last couple months and even years. So the GameStop situation, I'm going to talk about that a little bit. I'm going to talk a little bit about cryptocurrencies. I know that's something that we're all hearing about, but we might not understand exactly what they are. And then also talk a little bit about ESG investing, so socially responsible investing. And then lastly, I'll leave you with some places that you can find more information on all these things. All right, so let's get started here. So let's talk about some common investment types, stocks and bonds. I am sure those are names that you are familiar with. At least you've heard of those. So let's start with stocks. Stocks are also known as equity, and they represent ownership in a company. Stocks are most often publicly traded, bought and sold on exchanges. Some exchanges that I'm sure you've heard of are the New York Stock Exchange or the NASDAQ. Stocks can also be bought and sold privately, but that doesn't happen as common. Stocks are typically bought as an aggressive investment vehicle in a portfolio. And there's really two different ways that your money can grow by purchasing stocks. So let me give you some examples of both of those ways. First would be through appreciation. Let's say we have an individual who buys Starbucks as a company, and they believe that company is going to grow. When that individual bought Starbucks, they bought it at $50 a share, and that individual bought 10 shares. So 10 shares, $50 a share. That individual spent $500 initially buying Starbucks. If we look at Starbucks today is worth over $100 a share. So that individual's stock or the shares that it owns in the company have appreciated and grown. If that individual were to sell its shares of Starbucks, it would have earned money. That's one way that stocks appreciate and your money would grow. The second way is through generating income or receiving dividends. So let me give you another example here. Let's say we have an individual who owns the company McDonald's. Now, it's not to say McDonald's share price could go up and down, just like we talked about with Starbucks. That can certainly happen, and your money can grow that way. But McDonald's actually pays money out to its shareholders on a quarterly basis. What they did last quarter was every shareholder received $1.29 for every share that they owned, and that's called a dividend. So stocks can pay out dividends to their shareholders as well. So again, two ways that you can earn money through stock is appreciation and through income like dividends. Bonds. So bonds are also known as fixed income, and they represent debt. We oftentimes see bonds purchased in portfolios as a more conservative investment vehicle. They help limit volatility in a portfolio. Really, what happens when you are purchasing a bond is you're entering into an agreement with a company. You're loaning that company your money with the agreement that that company is going to give you back the money you loaned them and interest over a set period of time. So again, bonds are a little bit more conservative in the sense that you know the money that you're going to make on a bond right away. You know what the interest rate is. Interest rates tend to move up and down. So when interest rates are low, bonds are going to look a little less attractive to hold because you're not going to make much by owning a bond. As interest rates are higher, bonds are going to look more attractive. You're going to earn more money by owning a bond. In today's world, interest rates, as I'm sure most of you know, have been low for quite some time. So bonds haven't been as attractive to hold in portfolios. All right, mutual funds and ETFs. So mutual funds and ETFs are very similar investment products, and ETF stands for an exchange traded fund. Again, they're similar products. What they are is a collection of stocks, bonds, or other securities owned by a pool of investors. That pool of investors could be individuals like yourself. That pool is then managed professionally by a fund manager or a fund management team. There are thousands of different types of mutual funds and ETFs out there for you to pick and choose from, and they cover a wide variety of different investment objectives. So you can have a mutual fund that is invested in all stocks, and it's very aggressive. You can have a mutual fund that's invested in a combination of stocks and bonds, so it's more of a balanced investment product, or you can have a mutual fund that's invested in all bonds, so a much more conservative investment. So again, there are thousands of different options out there that you can utilize. The real big difference between mutual funds and ETFs is that mutual funds are not traded on a stock exchange like stocks are. They're actually, the price, their share price, will only adjust once daily at the end of the day. ETFs, just like stocks, trade on an exchange. So the price of an ETF is going to fluctuate throughout the day, like we talked about with stocks. Again, there's a real big difference between the two. These types of investment products are really great to diversify your portfolio. By purchasing one mutual fund or one ETF, you're going to be investing your money in a lot of different companies. So it's a great way to diversify your money. A couple more common investment types that I'm sure you've heard about. These are more complex and a little bit more sophisticated. So stock options, annuities, and alternatives. Stock options are a contract between a buyer and a seller, which gives the right to buy or sell a stock at a specific price up to a specific date. Again, these are much more complex products to understand and to utilize in a portfolio. We oftentimes see sophisticated investors use stocks to possibly hedge the markets or hedge a specific stock. If you think a stock is going to go down or up in a certain amount of time, we oftentimes see stock options used in those types of scenarios. Annuities. I'm sure we've all heard of annuities as well. Annuities are an investment contract with an insurance company. There's a lot of different types of annuities out there. There are fixed, variable, indexed, and then combinations of all of those. Fixed annuities are going to be your most conservative type of annuity. Variable are going to be your most aggressive. So they cover a wide level of risk. And oftentimes we see individuals purchase annuities for protection against loss of the value of the money that they hold, or also we see individuals purchase annuities if they're concerned that they're going to run out of money in retirement. This is one way that you can kind of protect from that. And then lastly, there are a lot of other investments out there. We kind of lump them all together. We call them alternative investments. So alternative investments could be something like a hedge fund or what we refer to as real assets or commodities. Some examples of some commodities that you might be familiar with are gold, copper, oil, things like that. Those are commodities. And this might sound crazy to you, but you can actually buy gold, like a block of gold. You wouldn't be able to keep it yourself. That would be a challenge. You can actually buy a block of gold, though, and it'll be kept safely in a vault for you. And that would be considered a real asset. You're actually physically buying gold. So now that I talked about some common investment types that we see, let's talk about the different types of accounts that you can hold those positions in. I'm going to break it down into two different types of accounts. First are qualified accounts and then also non-qualified accounts. So let's start with qualified accounts. Qualified accounts are those types of accounts that receive special tax treatment by the IRS. I want you to think of retirement accounts. Those are the most common type of qualified accounts that we see and we're familiar with. So 401ks, 403bs, traditional and Roth IRAs. Those are what we call qualified accounts. On my next slide, I'm going to talk a little bit about how we can put money into those accounts and receive a tax benefit, but know that there are some tax benefits to saving money in qualified accounts. If you don't follow some strict rules set by the IRS, there are some penalties that you would have to pay if you wanted to access your money within these accounts before you decide to retire, since these are considered retirement accounts. So just know that while there are some benefits to these accounts, there are some strict rules that you need to follow, and if you don't, there could be some penalties. Non-qualified accounts, these are much more flexible. They don't receive any special tax treatment through the IRS, and because of that, you can pretty much move your money in and out of these accounts at any time without having to pay a penalty. Some common examples of non-qualified accounts are just simply individual or joint accounts. Joint accounts, oftentimes we see spouses open up a joint account in their name, they put money into that account and they invest it, and then it grows, and then they might use it to buy a car, buy a house, pay off debt, things like that. So that's just a standard non-qualified account, or what we call as a non-qualified account. Okay, so if we go back to qualified accounts, let's talk a little bit about the two different ways you can save money into those qualified accounts. So the first option is pre-tax or traditional contributions, and then the second option is Roth contributions. And I'm sure that we've heard the names of both of those contributions before, but let me break it down for you and talk a little bit about the benefit of both of those. So pre-tax or traditional contributions mean that money that you're putting into a qualified account, you are not going to be paying any income tax on that money today. The money that you're putting into those accounts, it's not treated as income to you today, and it's going to go into that account. It's going to be invested over time. When you pull money out of that account when it's time to retire and you need to withdraw, you are then going to be paying taxes on that money on the back end. So anything you've contributed and the growth that you've earned on your investments, as you pull it out of those qualified accounts, it's going to be treated as taxable income to you. So we call it tax deferred, meaning you're not paying taxes up front, you're deferring, and you're paying taxes on the back end. That's pre-tax or traditional contributions. I'm sure most of us are familiar with that. If we put money into 401k, it's typically the default way that we see people add money into retirement accounts. Roth contributions, I believe they were introduced back in the 1980s, and I would say over the last 20 years, they've become a lot more popular. So basically, Roth contributions are the exact opposite of pre-tax or traditional. The money that you're putting into those qualified accounts today, it's going to be treated as income to you today. So because it's treated as income, you are paying tax on that money today. It's going to go into that retirement account in your name. Then down the road, when you decide to pull money out, everything you pull out of that account is actually going to be tax-free dollars to you. So again, you're going to pay taxes up front. You're not going to pay tax on the back end then. The big benefit to this is that all of the growth that you've earned on your investments over that time that your money was invested is tax-free dollars to you. Where in pre-tax or traditional contributions, you got to pay tax on all the money you pull out on the back end. Roth, because you paid tax up front, you don't have to pay any tax on that money down the road. So which is better? And there's a lot to consider, and it typically really depends on your personal situation, but I'll give you some things that we talk about when we think about if we should be doing pre-tax or Roth contributions into our retirement accounts. First is age. Oftentimes, younger individuals, Roth contributions make more sense for them. That's for a couple reasons. Reason number one being they have a long time for their money to grow and a long time for their money to be invested. The longer time horizon you have for your money to be invested, you have the ability to grow a really large tax-free balance for yourself in retirement, which could have a huge benefit to you when it comes to planning for retirement. Reason number two, that if you're a younger individual, Roth might make sense for you is because of taxes. Oftentimes, younger individuals don't care about taxes, so why not pay taxes today if you don't care about them? The other reason is when we talk about taxes is that a lot of people think tax rates are going nowhere but up from here on out. So why not pay taxes today with the idea that you're at the lowest tax rate we're ever going to see? Taxes are only going to go up from here, so lock in that low tax rate now. So that could really make sense for anyone's situation, not just a younger individual. So again, there's a lot to think about when deciding on whether or not pre-tax or Roth contributions might make sense for you. Age, tax bracket, time horizon, all of those different things to consider. I'll tell you, I do Roth, and most people in my office that I work with do Roth contributions, so we fully believe in the benefits of Roth. All right, so I'm going to share some charts here and get into some numbers. Compound interest. This is an interesting topic, and we all love to see compound interest work, but it takes time for it to work. And it really comes down to the rule of 72. I know I mentioned that I'm going to talk a little bit about a math formula. We call it a financial formula, and it's called the rule of 72. And the idea behind the rule of 72 is that you want to know how long it's going to take for your money when it's invested to double. That's what this formula is going to tell us. So how it works is you take the number 72, you divide it by your rate of return on your portfolio. So to keep it simple, let's say the rate of return on your portfolio is 10% over time. You take 72 divided by 10, and you get 7.2 as your answer. So your account would take 7.2 years to double. That's what the rule of 72 is. Kind of interesting. So as you can see, the higher rate of return you're receiving, the less years it would take for your account to double. The lower rate of return, the more years it's going to take. On the right side of the page that you're looking at here, it takes a little scenario here, and it takes an individual who starts with a penny on the first day of a month, and that penny is going to double every single day through the end of the month. The question is, how much money is that individual going to have saved at the end of those 31 days? You can see the answer. It's $10.7 million saved over that 31-day period. Now, it would be great if we could have all of our accounts double every single day for 31 days. That would be perfect. Life doesn't work that way, but I do this to show you that you look at those first 15 days that person is saving and their money is doubling, it doesn't really grow that much. You have a penny on day 1, and then by day 15, you have $163. On days 16 through 31, that's where you really see the growth. You see that on day 16, the individual has $328, and then it ends with $10.7 million. So really, there's a lot of benefits to keeping your money invested for the long haul, so you can see it double over time. And then the more you have, the more you will earn, and that's due to compound interest. All right, so talk a little bit more about time. I love this chart. I apologize for the cheesy names. I wish I could change it, but I can't. So this talks a little bit about time as well. And again, time is so important when we talk about investing. So I'm going to start at the top of the chart where we see consistent Chloe in blue. She is going to, all of these individuals are saving in different scenarios. She is going to save from the time she's 25 until she's 65. $200 every single month from she's 25 to 65. That's $96,000 out of her pocket over that 40-year time period. She earns a 6% rate of return over that time period, and her ending portfolio value is almost $400,000. It's pretty impactful, just $200 a month, and she can save almost $400,000 over a 40-year time period. We look down below on the next person, late Lila, she's in purple. She saves from the time she's 35 till she's 65. Same rate of return, so she's earning 6%. So she's missing the first 10 years, though, that consistent Chloe got. So it's a 30-year time period for her. She saved $72,000 out of her pocket, but her ending portfolio value is only $200,000, almost half of what consistent Chloe has, all because she missed those first 10 years of saving. The next individual in gray is Quitter Quincy. He starts saving when he's 25 and then stops when he's 35. So he saves for the first 10 years and then never saves again, earns the same rate of return of 6%. He only saves $24,000 out of his pocket. And by the end of this 40-year period, he has saved almost as much as late Lila. So he only saved for the first 10 years, but because he had time for his money to grow for a 40-year period, he has just under $200,000 saved over time. And then lastly, we have Nervous Noah. Nervous Noah saves the same amount as consistent Chloe. So for 40 years, he saves $200 every month, but he keeps his money in cash. He's nervous. He earns 2% on his money, and you can see his ending portfolio value is the smallest. It comes out to be about $150,000. So I like this chart. It tells a lot of different stories about what you do with your money. I think that it really speaks to, if you can, start saving early, even if it is a little bit, and save consistently. You can really see how it benefits individuals from not stopping saving money over time. All right, and then we talk about the risk of trying to time the markets. Timing is very tricky. When we talk about timing the markets, there's really two different things we have to get right. So first, we have to know when to get out of the markets. And you might be able to figure that out. Maybe you anticipated this COVID shutdown to happen last year and you wanted to pull your money out of the markets in anticipation of the markets going down. That's great. But you have to get that right. And then you also have to know when to get back into the market. So it's one thing to know when to get out, but then you also have to know when to get back in. So you have to get two things right. This is really why when we talk about saving and investing, it's not a sprint, it's a marathon. You're doing it for the long haul. And you want to keep your money invested over that entire time period, knowing that the markets are going to go up and down, and that's okay, but they are going to grow over that longer term time period. So this chart, what it's showing you is a $10,000 investment back in January of 2001, how it would look today or at the end of December of last year, a 20-year time period. So there's no money getting added, it's just an initial $10,000 investment. It's going into the S&P 500, just a brief overview of what the S&P 500 is. It is the 500 largest companies in the United States. It is market cap weighted, meaning the larger the company, the more it makes up the S&P 500. So these $10,000 are going into the S&P 500 back in January of 2001. You can see an individual who was fully invested for that 20-year time period, their money is over $40,000 at the end of that 20-year time period. So their money quadrupled. And their rate of return over that time period is about 7.5%. We bump down to that next bar. We can see that if that individual got nervous, pulled their money out a couple times, and missed the 10 best days the market had over that 20-year time period, just 10 days over a 20-year time period, their account balance is less than $20,000 at the end. And their rate of return is about 3.25%. So just by missing 10 days, the 10 best days, it had a huge impact on the overall portfolio value. You can see what happens when you miss the 20 best days, 30, 40, 50, and 60. After you miss the 30 best days, your return over that 20-year time period is actually negative. So it's really important that you keep your money invested for the entire time, and you just need to know that the markets are going to move up and down. It's normal. Volatility is normal. And interestingly enough, it says it on this chart here that 6 of the 7 best days that occurred over that 20-year time period happened directly after the worst days. So normal to see a really bad day and then the next day be a really good day. All right, so let's talk a little bit about some current events. And let's start with the GameStop situation. So I have it listed on here as shorting stock, and that's really the idea behind this whole scenario that played out. So let me explain to you what is a short, what is shorting stock. So if you think that stocks will go up, you buy them. If you think that a company or stocks will go down, you short them. So pretty much that simple. And how it works when you want to short a stock is you have 2 separate parties. You have one party that owns the stock, and then you have a second party that is borrowing stock from party 1. So in this scenario, we have party 1 that owns the stock. We have party 2 that would be these hedge fund companies in the GameStop scenario that are borrowing stock from party 1. These hedge fund companies had this idea that GameStop stock was only going to go down. They didn't believe in the company, so they wanted to short it. So they entered into an agreement. They borrowed GameStop stock from party 1. What they do then is once they own GameStop stock, they sell it right away. And then what they'll do is They'll let it out there. They won't rebuy it right away. It'll take some time. The stock will either go up or down. When it goes down, those hedge fund companies will rebuy it at a lower price and return it back to party one, the owner. So I know it's a little bit confusing, but just know when you're shorting stock, you're actually only borrowing it. And the intention is that you borrow it, you sell it high, you rebuy it low, and then you return it back to party one. So in the GameStop scenario, these hedge fund companies wanted to short it. So they entered into this agreement. They were going to sell stock high, rebuy it low, and then return it, making a profit. The other name in this scenario are these people on Reddit that caught wind of what these large hedge fund companies were doing with GameStop. And in turn, they wanted to almost, excuse my language, screw over these hedge fund companies. And by doing so, all of these individuals on Reddit got together. They started this forum, I think it was called Wall Street Bets, and they said, if we start buying GameStop stock, it's going to drive the stock price up. So when these hedge fund companies, while they're in their short agreement, have to rebuy GameStop, instead of buying it lower, they're going to have to buy it a lot higher and therefore incur a loss. And that's exactly what happened. So it was a very interesting situation. There's still a lot to be told about what's to come. There's, I believe, some litigation out there about whether or not this was market manipulation. So lots to come on this situation. It's just very interesting to see how the internet actually had impact on what happened in the markets. Let's talk a little bit about cryptocurrencies. I know this is a topic that everyone likes to talk about, and it is very confusing. So simply put, cryptocurrencies are just digital currencies. They're supposed to be extremely secure. There are thousands of different cryptocurrencies out there. So I know Bitcoin is the name that we all know and hear about, and there are some others that have become quite popular as well, but there are thousands of cryptocurrencies out there. There is this underlying technology behind crypto, and it's called blockchain technology. It's incredibly secure and it's incredibly efficient. And we think that that's really where the potential lies in all of this talk. But again, Bitcoin is the most popular name that we hear out there. And let me just talk a little bit to that. So today, Bitcoin is worth about $30,000 a coin, or in the crypto world, it's actually called a token. So one Bitcoin is one token. We don't call them dollar bills, we call them tokens. So one token is worth about $30,000 today. Up a couple months ago, Bitcoin was as high as $60,000 a token. So that just shows you how volatile and risky it is to be purchasing cryptocurrencies. They move up and down drastically in very short periods of time. The way cryptocurrencies work is you just simply need to find two parties, a buyer and a seller, that agree to accept Bitcoin. So for example, up until a couple weeks ago, Tesla actually was accepting Bitcoin to buy its cars. You could pay for a Tesla with Bitcoin. You didn't have to use US dollars or any other currency. You could use Bitcoin. They recently stopped accepting Bitcoin, but as long as you have a seller that will accept Bitcoin as a currency, you can use it if you own it to purchase something. So banks and financial institutions right now aren't accepting it. Ourselves at RBC, we won't accept it, and we also can't purchase it for anyone. I think there's a lot to come on cryptocurrencies. There's a lot that's unknown. There's a lot more that I think needs to be regulated before I think more people can own it and will feel comfortable owning it. It's a very interesting topic because it's something we can't hold, and we're used to holding dollar bills and holding credit cards and checks, and this is something that's just out there, and we can't see it, we can't hold it, we can't feel it like we can with our own money today. And then lastly, I'll talk very briefly about ESG investing. So this is something that I'm really passionate about, and I think that a lot of people, if they know what it is, will become passionate about it and want to learn more. Really, the idea behind this is, the old term is socially responsible investing. And what it is it's really looking at non-financial factors when considering what companies to invest your money in. So let me give you an example of a fund that I use. It's an ETF. So if we go way back to the beginning of what I was talking about, an ETF is a pooled investment product. So by investing in just one ETF, I'm investing in a lot of different companies. If you want to look this specific fund up, the ticker for it is SHE, S-H-E. And the idea behind this fund is that it's invested in U.S. companies that have women in senior leadership roles, which is just wonderful. So I'll give you some examples of some companies that this ETF invests in. Johnson & Johnson is on that list, Netflix, PayPal. There are tons of companies that you would recognize, but you might not know had women in senior leadership roles. So a really great fund that I've been using in my own portfolio to not only hopefully grow my money, because that's obviously the ultimate goal, but maybe have a little bit of a positive impact on the globe as well. So again, there's 3 different topics that we break it into. It's environmental, social, and governance investing. So environmental can really mean a wide variety of things, but it could be companies that might have green initiatives. It might focus on the treatment of animals, things like that. Social is really talks about the structure of companies and businesses. Are they donating to nonprofits and communities? What are the working conditions for employees, things like that. And then governance kind of speaks to companies. Are they transparent? And women on boards, things like that. The SHE fund would kind of be factored into that governance side of investing. So there are funds out there that focus on these types of companies. It doesn't have to hit all 3 of those topics, environmental, social, and governance. There are funds out there that just focus on environmental, just social, and just governance, just like that SHE fund that I had mentioned. So where can we learn more? I'll leave you with what I use. I read a lot of books. I know that's not for everyone, but there are thousands of books out there that have fantastic information on the basics of investing, current events that are going on. Books are fantastic. And if you don't like to read books, that's okay. Try listening to books. I have the Audible app on my phone. I buy Audible books all the time. I listen to them when I'm driving, when I'm getting ready for work in the morning. It's a great way to learn more and to educate yourself. Podcasts are also fantastic. I love podcasts, not just for investing. There are some other great podcasts out there for entertainment purposes as well. So if you've never listened to a podcast, check it out. Some that I like that relate to investing are Marketplace, Morningstar, and Investing for Beginners. And then also I'll leave you with watching the news. The news is difficult to watch sometimes because they might not always tell the whole story, and it's not always exciting to listen to what's going on. But you'll get to stay up with current events, things that are going on in the world and that are impacting the markets and possibly your money and how it's invested. So I think watching the news is good to just really keep up with what's going on a day-to-day basis. All right, so let me wrap this up here. If I can leave you with 3 things today, it would be invest early if you can, invest regularly if you can, and invest enough. I know I made that seem really simple. There's a lot that goes into those 3 things, but if I could leave you with 3 takeaways, it would be those 3. All right, well, that was all I had. So Nicole, Lola, I'm going to turn it back over to you. I do have my email up on the screen and my office phone number. If anyone wants to reach out to me outside of this, you are more than welcome to. So again, please feel free to reach out by phone or email. Happy to answer questions offline as well.
Great, Emily, thank you so much. That was wonderful information. I think so many of us can identify with a lot of the information that you shared. I know I can. I was a late Lila, to use the names on that chart. And I just want to make sure that everyone that's with us today, if there are other late Lilas out there, yes, you see the impact that starting later has had. But one of my favorite sayings is, it's never too late to start. The sooner the better. So if we are starting a little late to the game, it's even more important that you're doing things like this and investing and working out a good plan. So with that being said, if you want to type any questions into the chat, or if you have a question, please use either the raise hand reaction or, just go ahead and if we can't see everyone, if you have your hand up, go ahead and just start talking. But I'd love to hear from others. I know one of the things that I hear a lot when I'm talking with women is they're just not sure how to get started, because especially with investing, it seems like, well, you have to have a large sum of money. That's the misconception, is you have to have a big amount to get started, and that's almost prohibitive. So I don't know if while we're looking for other questions, if Emily, you could speak on that, and that thought process of, well, I can't get started until I have a large amount of money.
Yeah, that is definitely not true for the people we work with. We work with all different ages of people, starting at different points in their life. So it could be someone who is a young professional and hasn't saved any money yet because they're a young professional. And we will put together a financial plan for them. So something that can start them out early and set them up for success. So there's really there's no threshold of money that you need to have saved in order to talk with a financial professional. You can talk with a financial professional at any time about anything. There's a lot of, I'm happy to do that. I mean, there's tons of people out there, though, that you can speak to. Just having a conversation is a good starting point to get you in the right direction to saving. And even if you haven't saved and you are a late Lila, that's okay too. It's never too late to have a conversation about how can I figure out, okay, I didn't save the first 20 years of my life. What do I need to do for the next 20 years to catch up and set myself up for success? The first thing you should be doing is having a conversation and not just ignoring the situation for whatever reason it might be.
No, that's great advice. Having a conversation will only benefit you. We do have another question, and that's that this individual would like to buy small amounts of stock for children in my family for birthdays and holidays. Any suggestions for a place or app where she can start?
Yeah, great question. So there are, and I'm going to draw a blank on the name. There are some apps out there that offer ways to do that for free. So unfortunately, oftentimes when you work with financial professionals like myself, we'll have to charge some sort of transaction fee in order to do it if it's a pretty small amount. So I would encourage you to try and do this on your own if it's going to be small amounts. There is an app, and I am drawing a blank on the name, that you can go through and you can do this all on your own. It is all for free. And outside of not wanting to, if you want to buy stock for yourself, you can absolutely do that. I know there is a site out there, TD Ameritrade is a great site to do things on your own if you want to buy stock on your own. Again, they don't charge transaction fees like oftentimes financial institutions like ourselves we have to charge. So there is a special app out there though that you can do it for children as well. If you Google it, I'm sure you'll be able to find it. And I'm so sorry, I'm drawing a blank on the name. Actually,
Avery just said is it called Greenlight? Is that the one?
Yes, I think that's it. Yes, that sounds right. Yes. Thank you, Avery. Yes, that sounds right. Yep.
Okay. Any other questions while we have this great resource at our fingertips? Okay, so I'm not seeing any other questions, but we do have some great other call to action follow-up steps, and I'm going to share my screen now and let Lola take us home with that.
But we will also share the slides, hopefully with everyone a little bit later, in an email or Her Traditions newsletter. The items we've kind of going to review, Emily did some of that, is we really wanted to give you an opportunity to educate you a little bit more and continue educating yourself. We think it's very important for you to have a trusted community banking and investment partner, whoever that might be. And we ask that you meet with them regularly and ask questions. Don't be afraid to ask questions. Know your financial personality. Myself, I am a freedom finder. I like to live in the moment. I like to short-term goals, save money for specific reasons. So my painting in the back is my freedom finder. This is my retirement plan. So I have to have it visually there for me to see. And that has helped me budget better for my retirement. to allocate more money to that and not saving for small purposes of an adventure, an experience over a shorter period of time. So allocating more money in the long run. It's really interesting if you take the financial indicator, what it'll come up with and how it'll help you establish goals that make you feel good about what you're doing in your life. Use online budget and retirement calculators. Our website does offer that as well. So you can go into traditions.bank and you can go into calculators, and it'll give you, if you want situations where you're saving a certain amount of money over time, what you think you're able to save, and it'll give you an end result. So there's all types of calculators out there for you. Take advantage of educational seminars. Emily really hit it out, spoke a lot about that. We hope that this session gave you a better understanding of your retirement benefits, your what your employer offers, and taking advantage of your match, whether it's Roth or through the IRA. Explore those options. Make sure that you are taking advantage exactly where you are in your life. Know the differences. We hope we've helped you understand the difference between saving for something and really investing for something for wealth in the future. And last but not least, establish an investment plan and stick to it over the long run. We do a great job of that as women. Select your investment vehicles that you feel comfortable with, monitor and balance your portfolio with life changes, and revisit your strategy when life circumstances should happen to change. At Traditions Bank, especially through our program, Her Traditions, we hope that we develop financial knowledge, deeper financial knowledge for women. We want to enrich in the relationships that we can have with each other. And ultimately, by women having greater wealth, it helps the entire community have greater wealth. We are here and we welcome the opportunity to sit down with all of you, regardless of where you are in your investing, as Emily said, to guide your way. Take the financial indicator and we will sit down and review that with you. And we team with RBC to sit down, come up with your budget of your income and how much you're spending, and really make your plans. We want you to become more confident, more educated, and be better prepared to make your mark. We thank you so much for your time today.
Just to touch on what Lola said, we do have online calculators on the Traditions Bank website. I'm not going to try and share right now since we're having some issues, but if you go to traditions.bank and type in calculators in the search bar, you'll pull up all kinds of calculators. I mean, from retirement planners to planning for your mortgage to doing different CDs, any type of option. Go check it out, plug in those numbers. I think when you see those concrete numbers rise and fall, it gives you a better idea of what you need to do in order to have some control. But as always, we are invested in your financial health and also any women's issues overall. We're always interested in providing topics of interest to you. So please reach out to us. Your feedback is invaluable. And we will be sending out a recording from today and some of the slides. So stay tuned for that. And as always, stay engaged, enriched, and inspired. Take care.